Welcome to The Explainer. Today, we're trying to make sense of the economy because, frankly, it is sending some seriously confusing signals. You see signs of strength in one corner and then some major red flags popping up in another. So, what is actually going on?
And yeah, this headline from CNN Business really just hits the nail on the head. This is the question on everybody's mind. The stock market's been on a tear, hitting new highs, but if you just peek under the hood, a whole bunch of other things are flashing some pretty serious warning signs.
Okay, so let's dive right into that contradiction. How can we have a record-setting stock market and all these red flags at the same time? To really get it, we need to look past the headlines and dig into the raw numbers first.
So, first things first, we have to understand the what. We're going to take a quick look at the key numbers that are shaping the market landscape right now, starting with some of the biggest indicators out there.
Check this out. This is the spot price of gold. It's that classic safe haven asset. You know, when investors get nervous, this is where they run. And right now, they're definitely nervous. The price has shot up over 25% just this year. That's a huge vote of no confidence in the market stability.
And then there's this number. That's the yield on the 10-year Treasury note. Now, that might sound a little technical, but it's basically the interest rate the U.S. government pays to borrow money, and it's a benchmark for everything: mortgages, car loans, you name it. The fact that it's been rising tells you the market is getting worried about inflation sticking around.
But here's the thing. This is not a one-size-fits-all economy. We are seeing a massive split in how different areas are performing. On one hand, you've got precious metals and tech doing really well. That's driven by that search for safety and by some really strong company profits. But then you look at other sectors like luxury goods, and they are definitely feeling the pinch from things like tariffs and just, well, shifting consumer spending.
Now, to understand one of the most talked about indicators, we have to look at the Treasury yield curve. And don't let the name scare you off. Just think of it as an economic health report. It's like taking the market's pulse, giving us a snapshot of its gut feeling about the future.
And this is where that tension becomes crystal clear. See, in a healthy economy, the curve slopes up nice and gently. But right now, we're seeing it get steep and fast. History shows us that when this happens right after the curve was inverted or upside down, it can be a major warning sign for a recession. It's basically screaming uncertainty.
So what's causing all these warning signs to flash? I mean, these data points don't just appear out of nowhere. Let's connect the numbers to the news stories that are actually pushing the market around.
I mean, just look at this list of headlines. They paint a really clear picture of an economy that's getting squeezed from all sides. You have a weakening labor market, inflation that just refuses to go away, these ongoing trade tensions, a massive federal deficit, and then you throw political pressure on the Federal Reserve right on top of it all. It really is a perfect storm of uncertainty.
So you've got record high stocks on one side and all these troubling headlines on the other. Is there any way to actually, measure the overall level of risk in the market right now? Well, one popular indicator tries to do just that. It's called the Mannarino Market Risk Indicator. Now, it's not a crystal ball, but it blends two really powerful forces: the strength of the US dollar and that 10-year Treasury yield we talked about. The theory is that when both of those are going up together, it's a huge signal of stress in the financial system. And right now, that indicator is reading about 230. By itself, that number doesn't mean much, but when you put it on a scale, the picture gets a lot clearer. And here's the crucial part. A value of 230 puts the market firmly in the high-risk category. Now, it's not at extreme levels yet, but it is a clear sign that investors are, and probably should be, acting pretty cautiously right now. This high-risk, high-uncertainty environment has created two totally different competing stories about where we go from here. You've got the optimists, the bulls, and you've got the pessimists, the bears.
So on one side, you have the bulls. They're looking at strong corporate earnings, especially in tech, and they're betting that the Federal Reserve is about to cut interest rates, which would be like rocket fuel for stocks. But then you've got the bears. They're pointing to some pretty scary fundamentals: a job market that's weakening, inflation that's still squeezing people, and a stock market that looks dangerously overvalued if you look at history.
And that brings us to the single most important event on the calendar, the one thing that could prove either the bulls or the bears right. We're talking about the Federal Reserve's upcoming meeting on interest rates.
The lead up to this meeting has been a real nail-biter. Just last week, we got data showing business inflation was cooling off, which was fantastic news. But then, the very next day, we got consumer inflation numbers showing prices are still stubbornly high. So the Fed is getting these totally conflicting signals, which makes their decision this week so much more critical and so much harder to predict.
So this is the billion-dollar question, isn't it? Does the market keep climbing, or do all these underlying problems finally pull it back down to earth? It really feels like it all comes down to this one decision.
And that's really what you should take away from this. The stage is set for a huge decision. The Fed is caught between a slowing economy and stubborn inflation, with immense pressure coming from all sides. Its next move is going to send ripples through the entire market. So the only question left is, will it calm things down, or will it just ignite the uncertainty?